It's time now to focus on mid-caps. Joining us today on Closing Bell with mid-cap stocks that you must have in your portfolio. These are mid-cap multi-baggers, according to Vinay Khattar, Associate Director and Head of Research at Edelweiss Financial Services. Vinay, good afternoon. Thank you very much for joining us. First, a comment on the overall mid-cap space and where you think that's headed before we get into your specific stock picks.
So, Menika, if you look at the overall mid-cap space, we have seen prior to the current year, mid-caps were trading at significant discounts to the large cap. There was a big valuation difference, which has been catching up very, very significantly. Now, the entire valuation gap which existed between large cap and mid-cap has mostly gone away. And if you were to look at just basket to basket, you are trading right now at neutral kind of valuation. And this gap could become positive for mid-caps. That means normally during the bull market cycles, mid-caps tend to trade at a premium or at higher multiples as compared to large caps. So that is one vector which is playing out. Secondly, across the sectors where you had significant beating down of smaller and mid-cap companies, all that has begun to change in a significant manner, because even for a little bit of positive tailwinds, you begin to see order traction, you begin to see operating leverages playing out, you begin to see significant upticks on bottom lines beginning to happen. So that's what is playing out currently. Market is expecting mid-caps to do very well over next 2 to 3 years, and that's where a lot of smart investors are putting their money in.
All right, so of the 3 stocks that you're going to talk to us about today, Vinay, your first one, if we can go to K&R Constructions and detail for us why you like that stock so much.
So if you look at K&R Construction, it's in the road EPC business. That means it executes road projects. And road sector has 2 models. One, EPC, where you just execute and take your money and go off. And the second is you bid for a particular road project, you build it at your own cost, and then you transfer it back, and then you put a toll on this. So K&R has been into the EPC side of the business, which is relatively asset light. You don't have to put too much of capital into it. Secondly, because of this reason, its debt has been pretty low on the balance sheet, and balance sheet has stayed much more healthier as compared to a lot of its peer group, where the debt has been very, very high, balance sheet is stretched. If you were to look at what's happened in the last 2 months, NHAI has gone up and put almost 5,000 kilometers worth of tenders out, which are likely to be completed over the next 3 to 4 months. Now, NHAI, because of this NHAI tenders, almost 3,000 kilometers of EPC projects are going to be out, where K&R could be a very big beneficiary. So a very good quality balance sheet, very high quality execution track record, large number of NHAI tenders coming out, all are going to be significantly positive for K&R. And our sense is that this stock could trade much higher over next 2 to 3 years.
It also has a small fledgling irrigation business, Vinay. Do you see big potential there as well?
There could be some potential there, because as the government focuses on the rural parts of the country, and the irrigation is one of the key areas where the government would want to focus on, irrigation could be a potential business for a lot of companies, including for K&R business. But right now, the overall influence and the heavyweight impact the company will see is on the EPC side of the business, and that's where we are betting on.
How the management pipeline, Vinay, because the story of a lot of companies like this is that they're great when they're operating the space that they are in. The moment they start expanding into other areas, and you point out in a report that they could bid for other new verticals, their management gets stretched.
That's a risk that you carry, Senthil, in a lot of mid-caps and small caps. That means if you find that management ends up diversifying too much, or they go into non-contiguous area from their current businesses, or fetter away their meager resources, you could find that the company's resources as well as balance sheet get stretched, and you may not necessarily get the returns. Having said that, in case of K&R, we find that the immediate triggers would limit K&R to the EPC contracts on the road side, and hopefully the K&R will stick to more on the road sector and continue to do well from here.
Okay, so you know the stock's already up over 200%, I think, year to date, Vinay. So what's your price target on this? Do you think that from a valuation point of view, there's much more to go?
So, Menika, the way we look at it is that, yes, the stock is up, and we recommend, from the point we recommended, it's up significantly. But these are structural buys. So if you're going to be holding on to K&R for 2 to 3 years, you would get significant uptick. If you were to just look at specifically the valuation, it's trading at almost 10 times 1 year forward, which is not necessarily cheap. But you don't have too much of value available in the mid-cap space across sectors now, given the kind of rally that you have seen in 6 to 9 months. So are we looking at value picks, or are we looking at good compounding stories? KNR would fall into the second basket of a very good compounding stories, and that's what we are betting on.
All right, Vinay, I'm going to come to the second stock, but just draw our viewers' attention to the fact that we have the first number coming in from IOC's second quarter earnings. That's a net loss number of 898 crores. We'll keep our eyes peeled to the bottom of the screen, but continue this conversation with Vinay. The second stock that you've picked out is Repco Home Finance. Now, this is a space that has been very interesting, with regards to several companies in the space. Many people have been very attracted to this space. Why does Repco stand out for you, Vinay?
So as you rightly said, Menka, the space is extremely interesting, and that's what excites us. So Repco is into small ticket home loan finance. There is a part of the book which is devoted to loan against property, which is almost about 15-20% of their overall book size. Now, Repco provides small ticket homes in the region of 10 to 12 lakhs, which is the average ticket size in Tier 2 and Tier 3 town. A significant number of borrowers are in the non-salaried segment, and that's where we feel Repco differentiates against the competition, because it's relatively easy to lend to a salaried individual. But the moment you go to a non-salaried individual, a small business owner, there is a higher degree of risk. That means your loan or your EMIs will not get paid back in time. And that's what Repco has mastered itself at. If you actually look at the amount of write-offs, the write-offs that the Repco has done over its history are extremely meager. That means you have ended up giving loans to people who may not have been in a position to pay you in a timely manner, but the actual default rates have been very, very low, which shows off in Repco's numbers. So you have a ROA of almost 2.5%, which leads to a higher return on equity. If you were to look at just the numbers part of it, it's quite comfortably placed in terms of capital adequacy ratios more than 20%, and the company could continue to grow at 25 to 30% its book size over the coming years. And that's what is very, very interesting with this company.
So it's trading at about 4.5 times book, Vinay, as you point out, but it's in a riskier business than lending to the salaried class. So at 4.5 times, you think it's not too expensive?
Senthil, as I said, there is not too much of value around there. So okay. Is it very expensive? No, I don't think so. It's very, very expensive. Is it cheap? It's not cheap either. Right. But is it a great compounding story from this point forward? Yes, it's a great compounding story. If you look at the last quarter's numbers, top line has grown by almost 30-odd%. Disbursements have grown by about 27-odd%. So, and if you look at the overall space, you are moving lower on the interest rate. It's anytime possible that the RBI would cut rates, which is going to be positive for the entire rate-sensitive sectors, including Repco. Second, the more we talk about smaller cities and urban development and 100 city agenda of the Modi government, players like Repco are going to be in a very sweet spot to have a higher disbursal growth rate. Okay. And that's what attracts us.
I know you normally don't set time targets, I mean, when your price will be hit, but your target of, I think, 595 is 10% away. By when do you expect that to be hit, and would you be consider revising that, because the growth in these housing finance companies has been mind-boggling in stock prices. So
you're absolutely right, Senthil. This has been our buy call from the time it got listed at about 170 rupees a couple of years ago, and the price targets would keep on getting revised upwards. These are structural stories that we want to advise our clients to retain, irrespective of the price targets, till the time the valuations remain in a limited comfort zone. These are structural stories that you would want to hold on to and play on as the economy grows and the sector grows.
Just one quick question on Repco, and Vinay, that is that these new NBFC norms that RBI has announced, will they impact the company negatively? It's a phased application of these norms, but nonetheless.
You rightly said that, Menka. It's a phased application of the norm. So in terms of standard asset provisioning, which has moved up from 0.25 to 0.40, certain restrictions in terms of tier 1 capital and so on, a company like Repco is in a very sweet spot, because it's much ahead of the curve. And given the easy timeline that the RBI has provided, we don't expect too much of an impact going forward.
All right, fair enough. Let's move to their third pick then, which is Ratnamani Metals and Tubes. Talk us through the investment case here.
So if you look at Ratnamani is a pipe manufacturing company, and like a lot of it's into carbon steel pipes, which is a more commoditized kind of a business. These pipes are used everywhere. And the second part of the business, which is relatively smaller, is the stainless steel pipe business. Now, the stainless steel pipe business is a much more robust business. Here, the company makes better margins. These pipes are used in very, very difficult environment. So they are used in nuclear power plant, they are used in refineries, they are used in thermal power plants. So these pipes are subject to very high degree of acidic environment, temperatures, and so on and so forth. Hence, the quality of the product here has to be very, very good. Ratnamani competes with major international players both in India and abroad, and that's what makes this company's product proposition pretty strong. It's already registered with the major guys in the world, including Toshiba, Saudi Aramco, and so on and so forth. An international opportunity on the stainless steel pipe could be very interesting for this company, and that's one of the reasons why we picked it up. The second reason why what makes Ratnamani attractive is that on the carbon steel pipe business, because of the huge amount of headwinds that the economy was facing over the last 2 or 3 years, you saw utilizations were pretty low. Ratnamani had tried to stuck to a minimum margin wherever it could, but it did not go and overbid just to use its assets. Now, with the tailwinds coming in, you are having a situation where the operating leverage is going to pick up. This will cause profits to jump up in a very, very significant manner, which you've seen happening in this quarter. So that's the bet on Ratnamani.
You know, I'm just curious, a quarter of, I think its profit comes from, or at least a quarter of its business comes from exports, Vinay. You know, much as that's an opportunity, as you spoke about, because the market outside is much, much bigger than the market in India. It's also a bit of a threat, right, at this point in time, given where global demand is?
Yes, it's a bit of threat given where the global demand is. But if you look at the overall penetration which Ratnamani has achieved in the global market and the cost advantage it has over its peers, we believe that Ratnamani will be able to face those headwinds even if they emerge in a appreciable manner. And overall, if you look at the refinery capex, which could be picking up in US, though the Europe continues to remain very much down. And the petchem capex, which could be picking up in certain other parts of the world, it is possible that the Ratnamani would be able to face those headwinds in an amicable manner.
All right. So what's your price target on this one?
As I said, the same for Repco and the KNR. These are structural bets. At this particular point in time, you are just at the beginning of the economic cycle pickup happening in India. You won't really want to keep this stock in your portfolio with a price target in mind. You would rather just play the economic cycle as it picks up over the next 2, 3, 4 years and just hold on to this one till the time the structural story continues.
All right, great. 3 picks there from Edelweiss as Vinay has taken you through the investment case of all 3 companies. That's Ratnamani Metals and Tubes, Repco Housing Finance, and KNR Construction. So Vinay, any disclosures that you might want to make at this point in time before we say goodbye?
It will be safe to assume that these stocks could be in my own or my clients' portfolios.
All right. Thanks very much for that. And thank you very much for sharing some of those investment ideas with us. Those were 3 mid-cap stocks that Vinay says you must have in your investment portfolio.